Okay, everyone, here we are at the start of summer, June 20th, and we're back with another issue of Macro Matters and kind of recap what we've seen this week from the Fed, et cetera. My name is Rich Excel. I'm co-host with my fellow co-hosts, Tony Zhang and Blaine Reed. Thank you both for joining me today. Looking forward to a good discussion. This should be fun. I think there'll be a little bit of disagreement, which is always fun. It presents both sides of the market. So welcome, guys.
Yeah, hi, Rich. Hi, Blaine. Apparently, like since our last episode, I think there were a lot of market development going on, especially after the FOMC meeting. There are a lot of issues that we can actually discuss. Information release over the market and price in the markets. I think haven't really fully pricing all of the potential risk here, but we can actually discuss with that.
Absolutely.
Agreed. Happy to be here. Good to see you, Rich. Good to see you, Tony. Looking
Yes.
Well, I
forward to it.
wanted to start everything with start off the discussion, I should say, with um, the Fed, right? That was the big news. The Fed didn't cut rates. No one expected them to cut rates, but a bigger deal was probably the dot plots, right? We get those quarterly, we get the updates on the dot plots, and everyone wants to know what the Fed's thinking in terms of rate cuts or no rate cuts. And I think maybe Blaine, we'll kick it off to you first, and I've got the picture here up on the dot plots versus the Fed funds futures, et cetera, where you can see the market somewhat aligned for this year, but maybe a little bit more dovish for next year. But what was your takeaways from the Fed meeting, et cetera, and from the dots and how the market reacted?
Yeah, so I think overall, like you said, the expectations were for no move. That's what we got. That was what I felt. I believe the market and the Fed was still thinking about maybe two rates by the end of the year. I mean, I think two rates at most is probably what I was thinking going into the meeting. That's kind of where I thought the Fed chair left it. I think data dependent is continuing how, it continues to how they want to be. And I think even going in, prior to this cycle, that's how they've been. And I tend to kind of default to that, listen to what he's saying, not try to get too far ahead of it. And I think he's sticking to his guns and he's going to wait and see how some of these tariff policies move through and potentially impact, his decisions down the line. So to me, that's what was coming out of the Fed. Be curious to what you and Tony think. And
Yeah,
then,
so
and then
if
this
we,
morning, real quick, we just got,
yeah.
Waller out saying that maybe he sees a rate cut by July. So there is some debate that's happening out there live real time. And so, I mean, it's all subject to, I guess, update and change depending upon on the numbers that we see. So
Yeah, and you'll probably have some people coming out to because there's a very big difference of opinion that we can see in the dot
Mhm.
plots, and you're going to have probably Fed members positioning to become the next Fed chair because they know that that decision is going to be made at some point too, and they know what the current president likes. But just looking at the dot plots for 2025, we get the dots from all 19 of the Fed regional governors and FOMC, et cetera. Not that all 19 are voting. But we do get an opinion of what all of them are thinking. And as we can see, seven of the 19 are voting for no cut, two are voting for one cut, eight are voting for two cuts, and then two are voting for three cuts. So the kind of the that consensus, like 12-ish, if you average that, is going to come in somewhere around two cuts, and maybe if you look at the overall weighted average, it's a little less than two cuts. I think on this panel we probably are equally as spread because I would fall in the zero cut camp, and I think Tony is probably in the two or three cut camp. And so, Tony, let's hear what is your thoughts on what the Fed said and what you think they should do.
Yes, why the Fed actually did not move on the interest rate during the FOMC meeting, but actually the press and especially this data plots have already illustrated a lot of information for us, especially when you actually look at the dot plot. We didn't see a consensus among FOMC committee members, just like we are right now, right? Apparently, we actually have some kind of different opinion. In my point of view, that I actually agree that we should actually see more cuts, more than actually two cuts, at least three cuts during this year. This is for a couple of reasons. But before I actually illustrate it, but let's actually highlight what the justification that I think the Fed is like continue to have their belief. What they actually say is, I think Chairman Powell mentioned that during the pressing is, it's very unlikely that the Fed predict the tariff impact over the economic growth and inflation. And that's why they say they have actually they would like to actually take a wait and see approach as what they did before. This is not a surprise to us, right? But however, it's like if we actually look at what had been going on recently since like the data about the wage growth and inflation and also the gas price and all this kind of information from I think in general perspective, we should actually see more of a negative impact from the tariff than the actually causing the inflation. So here is what we should anticipate. Apparently, higher tariff from President's administration or Trump's administrations might actually cause the like a short-term shock over the price. But however, if we actually imagine something that if we actually see some price spike over some of the goods, that many actually consumer will respond instead of like actually spending more, or they could actually spending less. If they spending less, and given the situation that the economic growth slowed down, we should actually see lower demand for goods, which actually will causing the price to actually to go down even further to a certain extent. And this is uncertainty where I think many of the FOMC meeting, a committee member agree that they actually would anticipate at least three cut, and two actually anticipate uh, uh, so two anticipate three cuts. Majority of them actually see the two cuts at the end of the year. So that's actually give a lot of reasoning, and some they also anticipated, given the reason that they want to hold only two cuts or no more than two cuts this year, is that they anticipated unemployment rate would actually go up that much. That's another justification because they say we have a strong economy. This is true. We do actually have right now very resilient economy in the United States so far compared to other developing country or either like a developer country as well. That's definitely true. But here, given another major situation is we not only actually face the fiscal spending issue or economic issue, we also have another like a fiscal issue. This is something that I actually we discussed previously, which is about the national debt. I think we will get into that topic, but my point is, I think it's like given the recent development over the macroeconomic and also the market reaction, I would actually think it's like having more of a rate cut this year will be more favorable to the stable economic growth and for the financial market stability as well.
Okay, fair points. Let me make the case for zero cuts now. And the case for zero cuts revolves around a few things. First of all, we know the Fed's got the dual mandate, as you mentioned, right? It's
Yes.
inflation and unemployment. Inflation, the data we got last month seemed to be somewhat supportive on the month-on-month basis, though the year-on-year numbers are still not where we wanted them to be. And in fact, if you look at what the drivers of inflation, the seasonal drivers, CPI is expected to creep back up towards 3% over the next 6 months and not continue to head lower. And that's not even taking into account the fact of what we're seeing with oil prices, et cetera. That was just from the seasonal aspects of it. So inflation is far from the Fed's target. And even if you look at import price index and things of that nature, where you're talking about what are the impacts of tariffs and tariffs right now, just of what's already been announced, not and implemented. We're looking at tariffs on the order of about 13-14%. Those could come lower, but they don't seem to going to come a lot lower than the 10% across the board that Trump has announced. That even though the courts have said that maybe that's not legal, that he does have other levers to pull to increase those tariffs. So um, yes, initially, you're going to see higher prices. Maybe that squelches demand, and then that leads to a recession that brings prices down later. Um, but the Fed has never acted preemptively, right? The Fed
Yes.
has always reacted to what's going on in the economy. And so I would not expect the Fed to anticipate inflation going up and then coming back down because of recession, leading them to cut rates now. In fact, they've already cut rates by 100 basis points at the end of last year, and we have yet to see the impact of that 100 basis point cut from the Fed. And so you've got, in the jobs market right now, while there are certainly some parts of it as I've been kind of writing about and talking about, recent college graduates, and the article in the Wall Street Journal this week highlighting how recent college graduates are facing a much higher unemployment rate than they've seen lately. That's usually a sign that the labor market is weakening and not strengthening. But still, the overall labor data is still around 4.2, 4.3%. So that again is not in any way suggestive that the labor market is weak. And so that the Fed has always wanted to react and not to preempt. And in fact, you could argue that they've already preempted by normalizing a little bit last year, and then we're about to see those lagged effects. And so I just don't necessarily see it. And then one other thing I wanted to kind of highlight that I'm trying to bring up here is if you look at the Chicago Fed National Credit Conditions Index, right? This is their own data, and if you look at that data, you can see that credit conditions, this data series is created so that the mean is zero, and the standard deviation is the deviation is one, but it's basically showing that credit conditions are still very easy. If I brought up other measures like the Bloomberg financial conditions, et cetera, credit conditions are still very easy. And so when we look at credit conditions are easy, the inflation has maybe come down a little bit, but not gone all the way to where they needed to be, and jobs are not really any worse off. Um, and the Fed has never really anticipated anything. I just don't see the case for the Fed cutting right now. And data dependent and waiting and seeing makes complete sense to me. And in fact, I think you see about a third of the members agree with that. Though clearly there are two-thirds that see a number of cuts. And so I think that there is a bias to them wanting to cut, but they just don't see the catalyst for that just yet.
One question I would bring forth, and something I think about too, is, and Tony sparked me thinking of this when he said that the Fed, isn't really able to predict the impacts of tariffs. And so when I think about tariffs, I think that there's kind of that first order impact of prices going up. And then there's this talk about the second order impacts, about how there might be inflationary impacts that flow through the economy that we just don't really know how that's going to materialize, if it does at all. And to me, that speaks to the anchoring of inflation expectations and the Fed's concern about that. And if they go too soon right now, let's say on lowering rates, and then they have these second order impacts from inflation that flow through the economy, and that unhinges the consumer's expectations of inflation. That's a lot, maybe a much harder issue to get back corralled in, so to speak, than if they wait and they kind of, see how these impacts flow through, if there are impacts at all, and then they can make their decision. I think that plays into the calculus as well, as just making sure that those anchored expectations on inflation don't become unanchored, so to
Yes,
speak.
that's completely fair, and I think we've seen that not just with Chairman Powell, but with previous Fed chairs as well, that they're really focused on inflation expectations and the anchoring of that, and it's a lot. If they lose control of inflation to the upside, they do have to ultimately cause a recession or thereabouts. And I think the other thing that, and you mentioned the fiscal, Tony, but we don't know what's going to happen with the tariffs. We don't even know what the tariffs will be. We'll know a little bit more on July 9th, perhaps. We don't know. But we also don't know how much of that will be passed on to consumers, how much will be absorbed into the margins, how much will be pushed back in the supply chain. So, waiting and seeing, because we're really in a period where we haven't seen tariffs of this level since the 1930s, and so it's hard for anyone to say that they know exactly what's going to happen. So it's easy to say we don't know, and I think layered onto that, if you look at the stimulative aspects of the big beautiful bill, it looks to be adding only maybe about 0.25 to GDP this year, but for 2026 and 2027, it's more like 1.5% of GDP, coming a lot from the expensing of capex, et cetera. And so there's a lot of fiscal stimulus also in the pipeline, in addition to the tariff uncertainty, that I think the idea of losing control of inflation to the upside, given that it's not back to where it needs to be, is something that I think is certainly plausible. And even though we get one or two good month-on-month numbers, that doesn't really change the trajectory and the trend, of what's going on. But Tony, you're the dove here, so what do you think on those?
Well, yes, I actually acknowledge. I think the points that raised by Blaine and Rich, both of you, are valid. I mean, to a certain extent, we definitely cannot predict precisely that how the second order of impact of the tariff and over the economy grows, and simultaneously over the I think the unemployment rate. When talking about the deal mandate from the Fed. Lots of us actually focus on the first one, which is actually about the price impact and from the maybe oil, crude oil, and other utility spending. But the second impact, second mandate, unemployment rate, as Rich, you suggest, or you mentioned this, everyone have been knowing that. I mean, many of the big corporations, including the Magnificent Sevens, like continuously lay off people or restructure or reorg the organization, given the reason, I mean, very specific reason that the AI evolvement or development disruption is happening quicker than ever. And this innovation, technology innovation of AI could be growing much, much faster than any policymaker or people have ever seen. Like we look at the AI developments like integration over different industry, including the financial service industry, tech, consumer staple, and this is just growing in a point that they are going to actually kill many of the like entry level like an analyst position or like an entry level programmer position, which used to have a high pay in a Wall Street or in the Silicon Bank. And once actually those high pay jobs got eliminated, or to I will not say completely 100%, but let's just say 60% or 70% that got eliminated, we will actually anticipate that we are going to see a depressing effect, to say, from that or ripple effect from that kind of a structure change over the employment. Yes, we actually still have a low unemployment rate, given like the public sector continue to recruit like a local government. If it's not federal government, it would be just a local government or state government continue to hire the people. But those are kind of jobs that are not necessarily like comparing the more or productive or having higher productivity than the jobs in the IT or on the Wall Street. So those kind of I think ripple effect has not been fully priced into the future movement of inflation. And my argument is strong here. I think that AI innovation or disruption, this is could be the final innovation in human history.
Oh, that's a bold statement, but maybe that's because the world's going to end, and so that's
That's
no.
correct.
I hear your points on the deflationary impacts of AI, but
Yeah,
it's and it is probably happening faster. But I just think that until we see that in the data, the Fed's not going to respond. They're not going to anticipate that because I think
true.
to Blaine's point, the risk is in the near term losing control, and then they have to overreact. But I think the other thing when we talk about stimulative aspects, I don't know to what extent you guys have watched this, but the Treasury, the Fed has been, backing off on QE, but the Treasury has been releasing funds from the Treasury General account, and that's been fairly stimulative as well, bringing it down by a few hundred, $1 billion, and so that's money that's been flowing in the economy. That's also aiming to keep financial conditions easy, which is forcing people out the risk curve and leading to risk taking, et cetera. And so that's why we're seeing some very supportive from very supportive prices. But I wanted to kind of maybe transition a little bit into credit markets. So we were talking about that ahead of time, and there's a chart that I came across that I thought was interesting. It was where it showed it's shared by somebody else, but it showed that how um, ETFs have now surpassed banks in terms of holdings of credit debt for the first time, corporate debt in the first time in history. So now more corporate debt is held by ETFs than even by the banks, which in and of itself isn't necessarily a bad thing, but it might be a sign that if there was any sort of credit event, we don't necessarily have the speed bumps in place to make things to slow things down, and it doesn't, again, doesn't mean things are, doesn't signal anything is bad, but it may signal that if things do get bad, um, there could be more volatility. So maybe Blaine, you can give us a little bit of an update on what you're seeing and thinking in the credit markets and how that market is responding.
Yeah, sure. No, thanks. So when I was preparing for the podcast this morning, I was looking at some price charts. My background in broadly syndicated loans, leverage loan market, and pricing action there has been pretty stable for the last couple of weeks, just looking at the charts. So I think overall, the market is kind of in this wait, maybe mentioned this last podcast, but kind of a wait and see mode. Um, we've got the tariff wait and see. We've got the Fed policy wait and see. Now we have some geopolitical wait and see. And you marry that against kind of maybe where the VIX is at. Maybe we'll talk about that a little bit later. Still inside of 20. So the market just seems to me a bit of wanting some answers before directionally goes one way or the other. I did see some interesting research out, a note on Bloomberg midweek from S&P about their default rate expectations. And the way they couch that is right now they're running kind of 4.3% here in the US. They expect that maybe to tick a little bit lower by March of 2026 to 4%. But what I thought was interesting, two things. If the tariff levels remain high, they adjust that higher to maybe 5.5%. So, again, kind of this wait and see, kind of understanding what the impacts are actually going to be. But default rates by their expectations could increase depending upon how these tariff policies come into effect. And then another interesting tidbit just for me was year to date, 40% of defaults are from repeat defaulters. So companies that have defaulted in the past are defaulting again. So you got to kind of read through that data about where these defaults are happening and kind of why that is. And then there was some research out by JP Morgan where they had their expectations for defaults out, and again, kind of 4.25%, I think it was going into next year. Which is a little bit lower than what we had, with the COVID situation and coming out of that, but still ticking a little bit higher than probably the average. So just a space to watch, I think. And then you mentioned the ETFs, Rich, and just my initial reaction to that is, who owns those ETFs? I'm sure there's probably some institutional ownership there, but also there's probably some retail ownership. So that dynamic, as you kind of mentioned about, banks used to be the biggest holder, now they're not. How does that play out in maybe what could be a weakening credit cycle into, the next year and a half, 18 months? So.
Yeah, and that's a fair point because that's another topic in DC is deregulation and how a lot of the mid-sized banks are pretty optimistic about the potential for deregulation, freeing them up, and so maybe there's an element where that would certainly help on that front where banks get back involved. But we've seen private credit in the private markets and we've seen ETFs in the public markets basically supplanting the banks right now, and so what does that mean? But Tony, how are you thinking about credit risk, credit spreads, earnings quality, et cetera? Just looking at the factors to watch, you see the equity investors seem to be having a preference for large, low volatility, high quality names, in which is usually more of a defensive tilt. But what is your read on any sort of potential credit risk in the economy?
Yes, Rich. I actually try to. I agree with what Blaine just saying about the holders behind the ETF. Definitely, they are typically like ETF will be people would think will be actually mainly held by the retail investor. But in the current scenario, like many actually like fund or mutual fund, hedge fund, they actually roll out the ETF actually just as one kind of a carrier for the fund that under their current management, just for more of a liquidity perspective, especially some private credit or PE related product and used to have no or low liquidity. And at this moment, if they want to actually exit, that definitely they want to actually roll out the ETF. However, if you look at most of the ETFs out there or recently released, most of them actually have very low liquidity. That being said, is they actually mainly will be hosted by some, I think, um, medium size or um, medium size of institution, typically in this case. So given most of the retail or Main Street has already got exposure to this certain risk bearing or high risk bearing ETF product. They are not talking about the general large cap ETF, which actually people have no interest actually to continue to introduce, like S&P. No one actually will continue to roll out another S&P 500 ETF, certainly. So given like many of mainstream investors already got exposure to this kind of risky asset product, I continue to argue that right now we see the risk of being in the market actually remain super high at this moment. However, this is the market reaction still aligned with our projection when we actually discussed earlier this year is on the given all of the high rate environment, it would not be favorable to the small cap, but rather the large cap corporation will continue to benefit because as what you just show here, the size factor actually remain to be the strongest factor given the situation, which actually is true. So it's like the size factor, you can see the market cap. And because large cap corporations, especially large cap tech, have a lot of cash flow and especially positive cash flow to so that they don't need to rely on the credit from the financial institution or financial borrowing, different from the small cap or even some mid cap, like in healthcare and other consumer staple industry. And similarly, under current situation, definitely we actually like to see some more of like a company with higher quality and higher earning growth. This will still be remain the same as long as the interest rate remain high, especially even though even though I argue for maybe three cuts like at until the end of this year from the current level, the interest rate will still remain to be super high, like 3.5 percent if that's the case, or 3.75. And this is still favor the large cap and large cap tech. I continue to think that investor getting exposure to large cap tech would still be much better, not only from the risk reward perspective, but also from the future, like more of um, risk diversification just perspective. That's also favor this kind of a allocation. Apparently, we discussed as well to have a more diversification for investors over their current portfolio allocation, more of exposure to some crypto, gold, and other like energy related product will be also a good choice. Rich, like
Yeah, for sure. And I think a few things you touched on. I think to me, I want to think of the large cap tech, and you talked about them, you know, announcing more layoffs, et cetera, which is clearly an AI impact. But it's also, I think, knowing that they have a high human capital aspect of those large cap tech firms. It also is indicative to me that they're trying to hold on to their margins and that they're probably more worried they're probably more worried about inflation than they are focused on growth. Because if they were really focused on the growth opportunities, they would probably be repurposing some of those people before they just fired them. But instead, they're laying them off because of AI, which tells me that they think their growth prospects are probably somewhat normal to muted it, and they're trying to hold on to their margins because they're worried about the cost of labor, which is a big driver of inflation. So I think that probably adds to the argument that inflation is much stickier than we think. But one thing I wanted to kind of highlight, and you mentioned a little bit who might hold some of these ETFs. There is a big bearish argument out there against, in terms of the passive in holdings, because we know passive investors via ETFs and indexes are a large portion of all the public markets, and not just the corporate credit markets, but the equity markets for sure. Um, and we know that there's over 11,000 people turning 65 every day, more and more people retiring, and by the age 70, they have a required minimum distribution. The bearish argument goes that, this baby boomer crowd that has basically been a tailwind to equity markets, and in particular to passive equity strategies and other risk-taking strategies, which has been a tailwind because of just the money consistently flowing in via 401ks, et cetera. At some point here, there's going to be an inflection point where that turns negative. When that will be, we don't know. But when that happens, you're going to start to see that tailwind turn into a headwind. And what will that mean for risky assets at that point? Again, that's one of those things where you would never want to go short a market waiting for that to happen, but you know that from a demographic standpoint, that's going to happen here at some point, and that could certainly be a driver. But maybe I don't know. Maybe I don't know how you feel about this, Blaine. People are just making too much money in their equity and credit products right now. Why would they ever want to sell?
Yeah, and it seems like we're only at the front end of this. I mean, there's been such a big push, especially in the private credit, to develop products that can be accessed by the retail investor. It's just such a focus, it seems, right now. But I agree with you. The demographics out there, that's an important question. And you're taking what typically are somewhat illiquid assets, bundling them up into a more liquid asset, into a form of an ETF, and then asking folks to invest into that. Not against the asset class at all. I think it serves its place, but those are some questions I have about just if there is some sort of a reversal of a demographic change that could put you know pressure from a different perspective on the need to sell some of these assets, raise cash, what have you, put pricing pressure on the underlying assets, all things that need to be thought through. So, and I actually have the JP Morgan numbers up in front of me. I just want to circle back on their
Yeah.
loan default outlooks, just so I have it right. They're expecting 3.25% for 2025 and 4.75% for 2026. So a pretty big increase going into next year.
For sure, yeah.
Yeah.
I mean, bundling up illiquid assets and packaging them to sell them people, maybe even sell them in tranches. Why not? We've never seen that before. That could possibly never go wrong, right?
What could go wrong, right? Yeah.
Well, speaking of risky assets, Tony, I wanted to kind of pivot a little bit and get your thoughts. I've got the crypto screen up here now. A big talk, we DC and its impact on markets, whether it's fiscal stimulus, tariffs, etc. Um, has extending tax cuts, a lot of different things.
Yes.
Um, that's always been talk, but stablecoin legislation has been moving through it's moved through the Senate, it's moved on to the House now. Maybe they'll work on some bills, and we've definitely seen an impact in the crypto market. Ethereum, which has been really a dog for the better part of the last year or so, has started to show some life. Of course, Ethereum has about a 60% market share within the DeFi world, and there's some thought that the stablecoin legislation it could certainly recatalyze, if you will, the move towards DeFi and the move towards getting things off of payment architecture such as Visa, MasterCard, um, and move it into different chains and a lot of the Ethereum and maybe even Solana, et cetera. We looking to do that, and it's not just the crypto, it's not just the crypto crowd that wants this to happen. It's also the major retailers. There's an article on Bloomberg this week that talked about how Walmart and Amazon are pushing for this because they would like to issue their own stable coins and circumvent Visa and save themselves billions of dollars a year. JP Morgan's push out the talk about how they want to maybe issue their own stable coin as well. So stable coins look like they're coming soon to us, and it looks like pretty soon we're going to have stable coins across every place that we possibly go to shop. And what does this mean for the world of crypto, Tony?
Well, yes, this is actually a big topic. As we mentioned, that definitely the Genius bill had passed Senate and it's moving over to House. And the stablecoin definitely received a lot of attention recently, like given the retail investors like a risk appetite toward this kind of risky assets, and apparently some we have continued to see like a extraordinary performance about the crypto related asset classes such as the stocks like the one you show here, the Circle newly stable coin related stock, and other Bitcoin have reached to the new high as well, surpassing I think getting close last week 110,000 like per coin. And this actually has received tremendous amount attention, and that's why we continue to support this kind of a argument that diversification should also has some allocation or space for the crypto asset within their current portfolio. And there are a lot of reasons behind the recent like a stable coin movement, and especially just if we actually look from the top-down approach, why the current, I think President Trump continued to support the crypto currency. I mean, if we recall it in last his presidency, that he was actually against the cryptocurrency, but now he is really in favor about the cryptocurrency, not just from apparently like his firm DJT got involved with the new issue about the debt to buy more cryptocurrency, but actually we look at the national level or macro level. It's like we actually face this significantly debt here, $37 trillion national debt here, and actually how do we actually get cut down the debt? And it's just like we might agree or we might not agree that I don't think it's very unlikely that we will see that the government spending deficit will actually come down under the current President Trump administration if the big beautiful bill got passed. That's what Elon Musk suggests. I think it's very difficult to have both big and beautiful remaining together. And if that's the case, that how do we actually get the current national debt solve the national debt crisis? And if we actually look around, why actually U.S. dollar remaining to be the global currency reserve? Apparently, putting aside the number one economy in the world, apparently would help. And apparently the strong military existence and power also maybe, and also the government credibility actually support the US dollar to be one of the major reserve. But if we actually record that most of the credibility of the US dollar was actually built on top of the oil. They actually they anchors again the crude oil after the Second World War. And that was, they actually decouple from the gold and actually anchor with oil. So now here, given the current situation, geopolitical tension within the Middle East, like whether here, the question is whether we are going to have a stable US dollar. This is also a big question. Now, also that, why do I actually mention that? Because like many investors actually haven't really completely understood like the risk associated behind the stable coin. They would say like from the government, they would continue to support that we actually need to have a stable coin, and only the legal entity within the U.S. soil will have the right to actually to issue the stable coin related product. As what Richie you just said. Walmart and some company also like to issue the stablecoin. But here, it's the underlying collateral of stable coins are either the US dollar or the government bond, right? So that's actually the population of the stable coin actually is tied to the credibility of the US dollar and US government bond. And that's why they want to actually provide more of liquidity toward through the stable coin toward the US dollar and also the US government bond to try to address this like kind of a crisis. However, we can see the argument for this circling is kind of weak if actually we do not have a strong credibility with US dollar and US government bond. And so that's the underlying risk associated with Bitcoin. But however, I mean, the continuously strong performance has the U.S. national interest behind it, behind the strong performance of Bitcoin. I'm not talking about Ethereum, about Bitcoin, because U.S. government right now is the largest holder of the Bitcoin. So everyone knows that.
Yeah.
So that's actually when we actually raise to the national security level. So that's what this is about. So like Warren Buffett never bet against America. So you should say if you don't want to bet against America, you don't bet against the stable coin. So that's also they are equivalent to what to another. So that's my thought and my interpretation behind that, Richard and Blaine. I want to hear your thought.
Yeah, no, that's super interesting, and the argument when we talk about what's going to replace the U.S. dollar as a reserve currency, because for all the problems the U.S. dollar has, the question is what's better, right? You don't look to the British pound, you don't look to the euro, you don't look to the Japanese yen, you don't look to the renminbi, which has no liquidity whatsoever. Though none of those can potentially replace the dollar, so it's a question of do we go back to gold and do we go to Bitcoin? And that's we've certainly seen those move up much more in price than the U.S. dollar has, of course. And so there is an element of that, but what's the extent to that? And then kind of circling back to the stable coin. Certainly see where there'd be interest from the retailers to issue a stable coin, and we can even see, to your point, Tony, an interest from the U.S. Treasury to issue a stable coin because that would create surplus demand for U.S. Treasuries and replace it from all the foreign holders that potentially don't want to hold U.S. Treasuries anymore. Well, that's fine. Walmart and Amazon will hold U.S. Treasuries instead then, and so they could find that replacement for that. But whether we return to a gold standard or whether we return to a world where the Amazon and Walmart replace all the banks with their stable coins, that worries me because that sounds to me like that's going to slow down growth because as much as everyone hates banks, banks are the ones that ultimately extend credit. And if we're trying to disintermediate the banks from the credit card market or we're trying to take them out of the private credit market or the corporate debt market or wherever we're trying to disintermediate the banks, or even if we return to a gold standard, while that sounds great and it is appealing from a fiscal responsibility standpoint, it also then reduces the size of the economy that we could have because you're going to reduce the amount of credit that can be issued in the economy at any given time. And so that's a painful adjustment on any of these fronts to the economy, which potentially sounds to me like the potential growth of the economy going forward is going to be much slower. Now that's not going to lead me to want to do anything make any trades this week on that, but it certainly is something that we want to think about. And I don't know to what extent uh, Blaine, you feel like when we talk about the extension of credit in the economy, we talked a little bit about from the standpoint of what we're seeing on a default basis or expectations, but from the number of players willing to provide credit, do you see any fundamental changes that are happening there, Blaine? And maybe we'll kind of end it there about the supply of credit more so than the demand of credit.
Yeah, so I think that's a great question. I think right now the argument is that there's a demand for credit, and these private credit, the functionality there is just stepping in to meet the demand that the banks can't meet themselves. So There hasn't been necessarily a disintermediation or a pullback in credit. It's just there's pockets out there of demand that haven't been able to have been met, and then there's been just a growth in overall credit that's been issued. How long that continues to grow, if there's a change in regulation that you mentioned earlier, where banks can maybe start offering and competing more against some of the private credit offerings. That I think would be the interesting point to watch. Is do we get to a point where the pie is kind of large enough, and then the banks kind of come back in and compete for what's already out there? Does it continue to grow? And then I had one question. I just was
Yeah, go
listening
for it.
to you guys speak about the stable coin on. So like a Walmart stable coin, Tony, when you said it would be backed by the US dollar, is that like a 1-to-1 ratio? Is that, and
Yes.
it just trades in the blockchain, and that's the impetus of it? Because I'll be honest with you, when I first heard about all these stable coins, I go back to thinking about, like, we were in a, when the states used to issue their own currencies, and we had
Yes.
all these different, currencies and bonds that were issued and notes, but this doesn't sound like that. So
No,
that's
it's not too far actually. We get to where
Yeah, yeah,
every
right.
retailer has their own stable coin. But I mean,
yeah.
just to your point, and I'll let Tony answer, but you can see I have the cryptocurrency screen up again. You see
Mhm.
Tether and US dollar coin are the two biggest of the stable coins that we have now,
Okay.
and they are priced at $1, and they're priced to stay at $1, or if they're priced in another currency, they're priced to stay at that currency. And then what they do is they take the money that comes in, they give you the stable coin, they take the dollars, and they buy treasuries with them. That was one of the big debates around Tether for a while. The New York AG got involved. Is what really was their collateral? Was it treasuries, or was it something else, etc.? But now we're kind of settling around the stable coins will have collateral that fully supports the dollars that have come in, and that's what will keep the price stable. But go ahead, Tony.
Yes, Rich, I think your explanation is very, very good. But here, I mean, the meaning of stable coin, the naming of stable coin itself by itself is very interesting. When you're actually saying the stable coin, what that really means is for one coin that you issue, you should actually literally have one no, dollar nominal collateral, either collateral to the US dollar or either collateral to the US Treasury. There are a couple ways. This is one is you have a 1-to-1 ratio collateral. Sometimes you can also utilize some algorithm to actually make sure it's close to 1-to-1 ratio. But things like this, since you have you actually tied it or link to the US dollar and US Treasury. That's why people call it stable coin, because it means it's a 1-to-1 and it's stable. Only US dollar and US Treasury can be stable. But if the US dollar or US Treasury is not stable, actually has what we haven't seen, it's not stable at all, because we haven't seen the US dollar actually depreciate almost 10% over 1 month. That by itself is not necessary. What people actually call it stable coin is just more of a from naming perspective. So there could be some things like people especially the firm, are they willing to actually take the leverage? I mean, some firm, especially outside of U.S. Soil, even though they issue the stable coin, just like Hong Kong on the special region in China, also actually issued a like RMB back stable coin as well. And the reason for that is really why the U.S. government or U.S. right now Congress passes the bill is that they really want to provide more of the surplus to the demand surplus, liquidity surplus to the U.S. dollar and U.S. Treasury that was actually trying to maintain the U.S. dollar like a global reserve currency place in the world, given we continue to have historical high 37 trillion, or maybe by if we pass the bill, a big beautiful bill that we can easily reach to close to 40 trillion US dollar bill. So that's actually a very, very tricky thing. Even though a lot of people will believe this, like a US dollar will continue to remain the global reserve currency, but the demand for the U.S. Treasury bill I think might not be as strong as like people will continue to anticipate. Given the current situation, you saw someone already have a huge debt, and then if with the someone has continued to pay like 4.5 or 4.25 annual interest, almost unsustainable issue. That risk-free rate for U.S. Treasury yield, U.S. Treasury, it may not be risk-free anymore. So that's basically repo back. The stable coin may not be stable at all.
And and uh and I just kind of want to end on that note. I mean, just I think the idea of algo stablecoins is maybe a little too soon for that, given the disaster that happened with the Terra or the
Yes,
Luna cryptocurrency and the Terra
correct.
algorithmic stablecoin. It essentially led to the last crypto winter that we had. So that might be a little far off. But to your point, Tony, about the sustainability of fiscal debt and therefore demand for U.S. Treasury, et cetera. Last chart I have up here is the 10-year, 30-year part of the yield curve. I think this is important because this really takes all Fed action out of the play here, right? If we look at shorter term parts of the yield curve, there's a Fed aspect of it. But here we've seen that it's been steepening, and really the only interpretation I think you can make is that the bond market is essentially saying that maybe the U.S. fiscal deficit is not as sustainable as the politicians seem to think, and we've more than doubled the cost or on this yield curve if we kind of go out to the 30-year versus the 10-year, and that's really kind of coming from the long run fiscal sustainability and then therefore the demand for treasuries. And so maybe I'll ask you first, Tony, and then we'll end with you, Blaine, on thoughts of how and when the market might finally come around to Elon Musk's view of cutting spending versus the persistent 7% deficits that the big beautiful bill is going to lead to for the next 10 years.
Yes, Rich. When actually looking at this chart, it's like it's actually why it's definitely very concerning from the longer term perspective of the U.S. economy and U.S. Financial market stability here. And as what we continue to see, if the big beautiful bill got passed, and definitely we are going to see the higher national data deficits going longer. And if we cannot actually, from the government spending perspective, cut the government spending, fiscal spending, that the current situation of financial market will not be stable as what a lot of investors will continue to anticipate that it's going to be. And the question is, in the past, is the U.S. exceptionist like might not be true anymore. Maybe starting in the beginning of year 2020, 2026. And if actually U.S. got involved into any other geopolitical conflict, such as the recent conflict, the war between Iran and Israel, that the situation could become even complicated. Given the all of the situation evolve, and this is enough justification that investor remain very cautious, and especially given the exposure to risky asset. I think this is we should take more of a defensive approach from now on. That's my takeaway, Rich.
Okay,
Like,
Blaine, I'm going to give you the last word on where there might be risk emanating from the treasury market and spanning out.
Yeah, I think a lot of what Tony said and you alluded to, I look at this chart and the first thing that jumps out to me is just the movement that we've had, starting in 2025, and it's been a pretty drastic movement when you compare it to some of these other movements on the charts. And I think what's missing here is also the relative context, which you mentioned, Rich, is you can look back and say, well, we're still below, on this chart levels that we saw in 2020 and 2021. However, I think you need to put in context the amount of debt that we're layering onto the economy, and then look at these moves in relation to that, and which is I think what Tony was saying. So I think it's concerning. There's been obviously a lot of folks out there in the press recently raising concerns. Some big bank CEOs,
Yeah.
some other debt managers that continue to beat this drum, and at some point it's going to matter. And I don't know. It's one of these things where it hasn't mattered. It hasn't mattered. It hasn't mattered. But at some point it will. And when it does, I think the market's going to it's not going to be favorable to folks. And so that would just be my concern, is just the amount of movement we've had, how quickly, and the real need to get some of the spending under control, because it's not sustainable in the long term forever like it is. So
You're absolutely right, and it's not just us saying it. To your point, it's Jeffrey Gundlach, Ray Dalio, Jamie Dimon, some people who have made a name for themselves in the investing landscape that are also drawing attention to this. But um, we don't know when it'll matter, but it'll matter at some point, and maybe it'll matter by the next time we get together, which will probably be just after the 4th of July holiday. Given 2 weeks is going to line right up with the 4th of July holiday. So anyway, thanks for anyone who's stuck around this long to listen to us. Thanks for your continued support, and thank you, Tony and Blaine, for joining me again. And look forward to catching up in another couple weeks or so.
that sounds great. Looking forward to it, guys. Yep.
Yes, me too. Looking forward to it. And especially we don't want to see any surprise here.
No surprises, only positive surprises.
Yeah, only positive. We don't want to see like a big surprise in the Middle East either.
No surprises there, and no July 9th tariff surprises.
Okay.
Okay, see you guys in a couple weeks.
Guys.
Yes, see you then.